What is whole life insurance and how does it work? Well, by the end of this video, I'll give you the necessary facts on whole life and the other options available to you so that you can make an informed decision on what's best for you and your family. My name is John Moakler, and I'm the founder of Moakler Wealth Management. And for the best advice on how to protect you and your family, subscribe to my YouTube channel, hit the bell notification so you'll be notified when we launch a new video. Now, I really see life insurance as a necessary evil. And what I mean by that is we haven't figured out how to escape death. The question is, what do we want to do with our estate? And do we want to make sure that Revenue Canada isn't the biggest beneficiary of our estate? If that's part of your estate goal, then I hate to pull down the curtain, but the answer to the question is permanent life insurance. The next question is, what's the correct coverage? Now, here in Canada, we have two types of permanent life insurance. We have universal life and we have whole life. Both come with pros and cons. If one of your estate goals is to minimize your estate taxes and to maximize the estate for your beneficiaries, then universal life is probably the way to go. You would pay the premium, you wouldn't overfund it, and you would achieve your estate goals. If, on the other hand, you're looking to tap into cash value and get some guarantees associated with the policy, then whole life is the preferred choice. Here in Canada, whole life companies have been giving out dividends for over 150 years, just like clockwork. And when those dividends are announced and declared, they are guaranteed and they can never go down in value. Where else can you see an investment product? That's correct, life insurance as an investment product that has a dividend that is declared, and once that dividend is declared, it can't go down in value. Universal life does not have these same guarantees. So even in World War I, World War II, 9/11, and in 2008, whole life companies continued to give out dividends. But let's look at 2008, for example. In 2008, universal life policies that had cash values, they went down like the markets. They went down 35 to 40%. But here in Canada, whole life policies had an average annual dividend in 2008 of just over 8%. So I like to refer to whole life as the fixed income anchor in our overall investment plan. Leave a comment in the section below and let me know what type of life insurance policy you currently have or what you're shopping for. And be sure to tune into the next video on how I'm going to be designing a tax-free retirement paycheck and how we can actually tap into that money in retirement. Think about this for a second. It's better to have life insurance in place and not need it than not have it and actually need it. Think about that. Now, whole life insurance has three components. It has the premium, the death benefit, and the cash value, or the cash accumulation portion. And the premium goes to pay for the death benefit and the cash value. Now, in the early days of the policy, in the first 5 to 10 years, depending on how it's designed, most of the premium will be going to pay the death benefit, or what we refer to as the cost of insurance. But after that time period, you'll start to see the cash value start to explode, and that's designed specifically to make sure that we have all of that money ready in retirement. When the federal government overhauled the insurance industry in January of 2017, some unique products started to emerge. And so one in particular is a Pay 10 whole life product. And what I mean by that is it's put in writing to you. It's guaranteed that if you make these premium payments for the next 10 years, the policy is guaranteed to be paid up and you do not need to make any more premium payments. I have a policy similar to this. So after the 10 years, I don't need to make any more premium payments, but the cash value will still grow. And it's designed to go right up to the right like a hockey stick curve so that I can tap into that money in retirement. Now, if you have 20 years prior to retirement, a Pay 20 whole life is the preferred choice. In the greater Toronto area, I have this female business owner who is in her early 40s, and she has a Pay 20 whole life. And when she turns age 65, it's been designed to turn on a tax-free paycheck of $239,000 a year from age 65 to age 90. Now, she waits just 6 more years from age 65 to age 71, because age 71 is when we have to convert RRSPs into a RIF. If we wait and turn on the cash value to create a pension plan for this female business owner, then instead of $239,000 a year, it goes all the way up to $345,000 a year from age 71 to age 90. So while she was alive, she tapped into a $6.9 million tax-free pension plan. And then upon her passing, her beneficiaries will receive the balance of the death benefit. In one of my next videos, I will be going through how to design a whole life policy to create that retirement paycheck in retirement that will create a tax-free retirement paycheck to you personally, even though it's fully funded by your corporation. This channel allows me to share my passion when it comes to financial planning. And so I will only produce content that I would like to watch. And so I will guarantee you that 110% of my effort will go into every one of my videos. So let me know if you're interested in additional information either on corporately owned or personally owned whole life insurance. Click on the link below to apply to become my client. And if you like this video, give it a thumbs up, subscribe to my channel, and share the video with a friend. And just remember, when we design financial plans for our clients, we make sure that your money will outlive you in retirement.